You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the Deep Dive. Our mission today, well, it's to give you that crucial shortcut to being really well informed about the global market landscape. We're taking a whole stack of pretty intense information, tracking foreign exchange, commodities, new trade policy, and frankly, a very crowded slate of geopolitical risks. And we're distilling the most crucial signals that are shaping the day ahead, just for you.
Yeah, and if you really look at the source material, the dominant theme across all these different segments is just tension. The whole global landscape right now, it's defined by a much firmer, maybe even aggressive policy pulse coming from governments. Think explicit tariffs, assertive central bank management, that kind of thing. But this deliberate action is sort of colliding head-on with almost unpredictable supply-side changes, especially in commodities, and a truly, truly volatile geopolitical environment.
Absolutely. And we're trying to trace how everything, from currencies to, kitchen cabinets, is basically wired together. So to kick things off, I think we have to start with those subtle signals coming out of the currency markets. We're not just looking at where rates are set, we're looking at how central banks are managing expectations, and where, despite their best efforts maybe to sound dovish, outright hawkishness is starting to leak out.
Exactly. You start with the U.S. dollar, right, which has been remarkably choppy. It's been hanging around that 98 handle, which, for those who don't live on a trading floor, just means the dollar index is sitting at a specific kind of stubborn level against its major competitors, and it's caught between that classic anxiety over a potential Washington shutdown and, the fresh details on those new tariffs we keep hearing about. The euro, by contrast, well, it's largely just been a passenger in the dollar's story lately.
Right. But the real insight, I think, comes when we look eastward, specifically to Asia. Because there, the currency movements, even when they seem minor, they're often highly managed, and so they carry major policy weight.
That's where it gets fascinating, the sheer nuance, especially coming from the Bank of Japan, the BoJ. Okay, so dollar-yen was technically unchanged, not much movement there. But the bank released its latest summary of opinions. Now, this document, it's essentially the minutes of their meeting, reflecting what different members think. And what stood out was a very specific hawkish tint. We saw at least one voice in there arguing it might actually be time to consider another rate increase.
Okay, but why does just one voice matter so much when it comes to Japan?
Well, because for years, the BoJ has been the global outlier, right? Committed to negative rates, extreme accommodation. So for even one member to publicly suggest, hey, maybe it's time to normalize further, it fundamentally changes how market participants price the yen long term. It's not an action yet, obviously, but it's a public shift in sentiment. It signals that the long, slow march away from ultra-easy policy is, it's continuing. That's why traders are definitely keeping one eye open there.
And that sentiment shift, it seems mirrored further south where inflation anxiety is still pretty high. The Australian dollar, it found some support after the Reserve Bank of Australia, the RBA, left rates on hold. But reading their statement, they didn't sound too happy about it.
Not at all. The RBA's language was extremely firm, actually. They really emphasized that the rate of disinflation, the slowing down of inflation, has decelerated. It's slowed down, it's slowing. And crucially, inflation risks persist. They are essentially saying, okay, we paused, but we are absolutely primed to act if those risks pop up again. This just tells you that the fight against price pressures, it remains global, even down in the Southern Hemisphere.
Right. And speaking of active management, the People's Bank of China, the PBoC, they seem to be using their daily tools to guide expectations pretty actively.
Oh, they're very active players, strategically shaping the resilience of regional FX, you could say. So the PBoC set the USD-CNY midpoint fix at 7.1055. Now, critically, this was slightly stronger than market models had implied it should be, based on overnight trading.
Stronger, okay. So pushing back a bit.
Exactly, pushing back against rapid depreciation. This simple act, it communicates to the market that the authorities are actively signaling they will defend against a fast fall. It provides a kind of soft floor and manages confidence without having to resort to, costly outright intervention. It's policy communication cleverly disguised as just a daily data point.
So the lesson for us here is clear. Across all these central banks, Tokyo, Sydney, Beijing, we're seeing these active strategies, and they seem rooted in, well, deep inflation anxiety and a real desire to manage volatility, not just react after the fact. Okay, now let's shift gears a bit. Let's leave the world of subtle central bank signals and look at where governments are, well, dropping hammers. Specifically, those new tariffs that are really reshaping trade flows. The White House has finalized a new tranche of concrete measures hitting specific, quite sensitive sectors.
Yeah, this action just confirms that firmer policy pulse we talked about right at the start. And these aren't general duties. They are very targeted. Starting October 14th, we're seeing a 10% levy on softwood timber and lumber. And simultaneously, 25% duties are kicking in on things like vanities and kitchen cabinets. That hits certain supply chains directly, obviously.
And they've explicitly built in a threat of future escalation, too. It's a clear signal to trade partners. Negotiate now or, well, suffer later.
Precisely. If there aren't negotiated deals, those cabinet tariffs, they're set to dramatically rise to 50% starting January 1st. And upholstered furniture duties, they jump to 30%. They also outline caps, somewhere near 15% for EU and Japanese wood products. This feels less about pure fair trade and maybe more about leveraging trade policy to protect specific domestic industries and force concessions from others.
And we don't even have to wait to see the effect of this leverage, do we? There's already a fantastic real-world anecdote about how this drives diplomacy and investment.
That's right. Switzerland, feeling the pressure from last month's, 39% import tariff on certain goods, immediately responded. They offered strategic investments into U.S. gold refining capacity. They are literally trying to exchange investment capital, maybe jobs, for tariff relief. It just shows how trade policy can immediately drive cross-border investment in these intense negotiation efforts. It's a powerful, pretty blunt tool.
Yeah, it really makes you wonder how that kind of aggressive trade environment impacts allies elsewhere, especially those maybe dealing with currency pressure.
Oh, it definitely creates significant strategic constraints. We noted earlier that the PBoC is managing its currency, but other Asian allies might be struggling more. South Korea's top security advisor stated it remains challenging, quite difficult actually, to secure a currency swap arrangement with the U.S. Now, in an environment where the U.S. is clearly prioritizing domestic protection and leverage, securing guarantees like a swap line, which, provides emergency dollar liquidity and really boosts FX resilience, that becomes exceptionally difficult. It just underscores a sort of political backdrop that's shaping regional currency strength or lack thereof.
Okay, moving on to commodities. Here we see a really mixed picture, quite a sharp contrast actually. Crude oil is under pressure, moving lower, while gold, the traditional haven asset, is pushing higher. Why the immediate downswing in crude? What's happening there?
Crude right now, it's almost purely a supply story. It's reacting to two main inputs, really. First, reports surfaced that OPEC Plus could consider raising output at their meeting next week. That's prospective supply hitting the news wires, dampening sentiment.
Right, the possibility of more oil.
Exactly. And second, maybe more concretely, Iraq moved to restart Kurdish exports to Turkey. Now, this had been suspended for more than 2 years, so this isn't just about volume. It's also a kind of political reconciliation that adds tangible, potentially reliable prospective supply back into the global market. That combination, well, it's a pretty clear bearish signal for oil prices in the short term.
Okay, so oil is reacting to physical supply and maybe some political stability there in Iraq, but gold seems to be reacting to the complete opposite. Policy instability and fear. Gold broke above its prior highs, extended its gains. Where's that strength coming from?
Gold is definitely benefiting from the fear factor right now. We saw haven interest, investors running for safety, mesh really strongly with technical momentum, pushing it through those previous levels. But the overarching driver, I think, is U.S. fiscal uncertainty. When the market sees ongoing brinkmanship in Washington, particularly the threat of a government shutdown or unresolved debt issues, basically anything that smells like policy failure gold benefits enormously. It acts like an insurance policy against political dysfunction.
That's a really key distinction for you, the listener, to hold on to. Oil reacting to immediate, concrete, physical supply changes. Gold reacting to the more abstract fear of policy failure or geopolitical uncertainty.
Right.
They're trading on two totally different narratives right now.
Okay, here's where it gets really interesting, I think. Connecting those market signals back to the dense geopolitical docket. We really have to address the White House's proposed framework aimed at ending the Gaza conflict. Yeah, the White House published a pretty comprehensive 20-point framework. It's quite detailed, ambitious even. It envisions a de-radicalized, terror-free Gaza, and it requires an immediate suspension of military operations once both sides agree to the terms. Key provisions include a phased Israeli withdrawal tied to certain security conditions being met, and crucially, the return of all hostages within 72 hours of Israel's public acceptance of the deal.
Wow, that 72-hour hostage return window, that seems like an enormous condition. What's the actual likelihood of this succeeding, given all the complexity on the ground?
That is the absolute critical tension point. President Trump stated a deal is beyond very close, which indicates, high political optimism from his side. He also added that if Hamas rejects it, Israel would have full U.S. backing to continue operations. So there's pressure there. However, the regional interlocutors, the Arab states acting as mediators, they're sounding a very strong note of caution, a very different tone. They suggest that acceptance is absolutely not assured. They point specifically to the difficulty of securing that immediate unconditional release of all hostages, and also managing the phased withdrawal timetable under potentially ongoing fire. The backing from states like Qatar certainly helps, but it doesn't guarantee compliance from both principles involved.
Right. And geopolitical risks aren't just confined to Gaza, are they?
Yeah.
We also got that stark reminder of security issues along vital trade routes. A Dutch-flagged cargo ship was damaged by an explosive device in the Gulf of Aden, injuring crew and igniting a fire.
Yeah, that's a direct, persistent threat to global supply lanes. Remember, we were just talking about oil supply. When maritime security is compromised in critical areas like the Gulf of Aden, the cost of insurance and shipping, it skyrockets. That just injects more uncertainty into commodity pricing and impacts supply chains all across the globe. It's a real knock-on effect.
And briefly, we should probably just note the Russia-Ukraine context, which continues to shape European policy significantly.
Yes, absolutely. President Putin continues to frame the conflict as an existential battle for Russia and vows to prevail, even as Europe is weighing additional steps, both fiscal and military, to really fortify its security posture. This persistent threat, it requires continuous high-cost planning by European governments, which feeds directly back into their fiscal management stories, like Italy trying hard to keep its deficit under the EU rules.
Which brings us nicely full circle back to policy, but this time, domestic U.S. political friction intersecting directly with the global markets, the risk of a government shutdown. Talks reportedly show little progress, and congressional leaders are signaling, no breakthrough yet.
This is a critical risk, especially for anyone trading currencies or trying to analyze central bank moves right now. The immediate implication of a shutdown is the risk of delayed federal data releases. And the biggest data point on the calendar, usually, is Friday's non-farm payrolls, the monthly jobs report. This report, it's arguably the single most important monthly piece of economic data. It's like the GPS for the Federal Reserve.
Okay, so if that report is delayed, what's the practical impact on markets? What actually happens?
Well, it basically introduces information scarcity into what's already a highly volatile environment. If the non-farm payrolls report gets delayed, traders are essentially driving blind. The whole process of price discovery, where the market tries to find the true value of a currency based on reliable information, that process is severely hindered. Central banks rely heavily on this data for their policy signaling, and without it, near-term FX pricing becomes much more speculative, which just exacerbates volatility.
Got it. And finally, let's just quickly wrap up our policy markers in Europe, which, as you said, feed into those broader currency narratives we started with.
Right. So Italy is preparing to forecast its 2025 deficit at or below 3% of GDP. That's to align with long-standing EU rules. This is a crucial political commitment, really, that impacts the perceived stability of the entire Eurozone. And separately, over in the UK, we saw shop price inflation tick up slightly in September. So these policy constraints in Italy and these inflation updates in the UK, they feed directly into the policy decisions and, the household income stories that ultimately underpin the demand and stability of the pound and the euro.
Okay, so to try and synthesize everything we've deep dived into today, it seems markets are clearly being shaped by these high-level, quite deliberate policy actions. The aggressive new tariffs, that hawkish BoJ signaling, the active PBoC currency management.
But at the same time, traders are nervously watching these concrete, potentially unpredictable supply shifts like the OPEC Plus and Iraq oil developments we discussed. And that's combined with profound geopolitical risks surrounding, say, the Gaza framework acceptance and those persistent maritime security issues.
Yeah, the takeaway for you really is that policy tension seems to be absolutely everywhere right now.
It really is.
So what does this all mean for you, the listener?
Well, the two key developments carrying perhaps the highest immediate market volatility risk are, one, the acceptance or indeed rejection of that White House Gaza framework, and two, the progress or maybe the devastating lack thereof on averting the U.S. government shutdown. Definitely watch those two storylines very closely in the coming hours and days.
And, that leads us nicely to our final provocative thought for you to consider today. We spent some time detailing how the threat of a U.S. government shutdown really complicates FX price discovery by potentially delaying the release of that crucial non-farm payrolls report. So think about this compounding effect for a moment. What if a major aggressive policy decision, like, say, that dramatic January 1st tariff escalation on cabinets we mentioned, what if that were to coincide with a period where we have delayed economic data, meaning we are effectively blind to the economy's underlying health? How much harder would it be, do you think, for policymakers and traders to accurately price the true risk involved?
Exactly. Information scarcity combined with aggressive policy action, well, it creates a genuine risk vacuum. Something isn't priced correctly. That's definitely one for you to mull over as you start your day.
Catch you on the next Deep Dive.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.